Welcome back, guys. Welcome back. And in the recording today, we're going to be discussing entries. Obviously, this is the juice for a lot of people where they get to know how to take the trade when the price approaches the POI. And we've got basically three types of entries that I'm going to be teaching you guys. And within those three types, the different nuances of things that you will then later realize when you go through them in detail. But the important thing is you just need to look for one method that you're happy with. All of them are profitable ways of entering the market. And if you know what you're looking for and you know how to identify what would be things that continue to occur in the market and present an opportunity for your edge to play, then you'll be fine. You'll be fine. So let's get into it. So the first one is called the risk entry. So basically with this one, it's very simple. It's a sort of a set and forget approach. So what you then simply do is you simply place a limit order right at your POI, wait for price to come back to your POI and set your TP at the nearest high. So in this case, you'd simply be waiting for price to come in here and push back up, and you're in the money. It's that simple, all right? So with this one, of course, what you'd obviously be expecting is that whenever price triggers your limit order, your hope is that it doesn't stop you out and it turns in your direction before it breaks this previous low over here, all right? So with this one, there's this way of doing it where you put your limit order right at the top of the order block or point of interest, and then there's another approach where you half the order block and you put your entry right at 50% of the order block, and then there's a third approach where you put your entry right at the top, but what you do is you first wait for price to trigger 50% of the POI, and then you place a stop order, in this case a buy stop order, right at the top of the POI, so that when price reaches 50%, if price is to turn back and move in your direction, it triggers you as it does that and moves in your direction. Those are the three ways that I know to enter to take risk entries. Obviously, there's a number of disadvantages to this. Number one is price can easily trigger you and blow through, because obviously the market doesn't know you and it doesn't owe you respect when it comes to your POI, right? So it can easily blow through and you take a loss, which can happen a number of times. The other sort of disadvantage with having your pending order at 50% would also be that sometimes you don't get triggered, price misses you ever so slightly by a few pips and then moves in your direction. Those kind of things happen. If you're going to go the 50% route, you're going to have to make peace with it. For me, that's one of my favorite ways of entering. But I have made peace with the fact that I won't be triggered all the time. And then with the third one, which is the buy stop one, what you may have is price comes to the 50% and triggers you in the trade, but still continues downwards. Those kind of things do happen. Also, you'll find whenever you have your pending order right at the top of the order block, your risk to reward ratio is not as beautiful as you'd like it to be. As when in a case where you'd have it at 50%, you'd nearly double your risk to reward ratio by just putting your risk reward right at the 50% mark or median price of that POI. So that's another thing to consider when you're taking a trade from the 50% point. So what I found is with this sort of risk entry method, you have to be really good with selecting POIs, because the hard work is with selecting POIs that are likely to be respected. If you are the kind of person who's just working on orders on every POI out there, there'll be tons of POIs within this bullish section over here, and you will take a lot of losses on your way down before you see any profits. So you definitely should consider maturing in how you pick POIs for entry, right? That would be the first thing. And then yeah, other than that, it doesn't get any simpler than that. You just have to pick and choose and live with the devil that you're happy to live with. In this case, for me, for when it comes to risk entries, I'm happy to live with the chance that I won't be triggered, and I'm happy to sometimes see price trigger me and blow through into the other direction, because I know when it does trigger me, normally the profits that I get and the RR that I get will be beautiful. So sometimes I'm happy to do that, and I don't have problems psychologically with executing such a system, because I'm at a point where I'm somewhat comfortable in terms of picking OBs. I'm probably not the best, but I'm happy with how I pick my POIs, and I'm profitable by picking those POIs and trading like that, right? So the second method that we use is called obviously the confirmation entry, and with this one, the idea is simple. So if we were to say this were our say H4 time frame with the yellow, then we'll be looking at our internal structure, maybe let's say our 15-minute M15, or you'd also be looking at your H1, depending with which one you prefer. Personally, I would say the M15 would be nice. Um, so let's just change this color and maybe let's make it green. All right, so what we're going to do now is we're going to watch as price obviously moves up in this sort of fashion. Um, and what we're waiting for is to see a change of character when price hits our POI, right? So this is what we're looking for. So this M15 is obviously our internal structure, right? And over here, what we see is when price hits our POI, it gives us a change of um, character, right? When it does that, what we're simply going to do is we're going to wait for the most recent POI, the fresh POI that's been formed when price changed character, to be respected and honored as price creates a high low. And then what we do is when price comes back to that POI, that's when we take our risk trade and then we aim for the highs. And as you can appreciate now, this is a 1 to 11 trade. The RR is much better, and there's a lot of value in that because you get to first have a confirmation from the market that the structure might be changing through a change of character. Okay, so what simply happens is, say you've got your H4 POI over here, M15 changes character in that POI, and then you wait for your POI to be triggered, and then you take the risk. You can also use any one of the three risk entry methods I told you. Maybe you use 50%, maybe you use a buy stop, or maybe you use your limit order that's right at the top, and you simply make sure either you accommodate this low of the fresh OB, or if you are not comfortable with that, then you accommodate the higher time frame low to make sure that you're not manipulated if this choice of a POI is wrong, right? Because we know that in the lower time frames, a lot of things look like changes of character, right? And then we've got what we call the double confirmation. So what happens with the double confirmation is simply that when price breaks a second time to give you this sort of bullish change of character, what's that? So let me just make sure there's a bit neater. So when you get this bullish break of structure, what you then do is, instead of waiting for this POI to be filled, you now move to the next POI because you know the higher low is in place, and what you're going to wait for is for price to then come and respect the second high low, and then that's where you take the trade. Now, obviously, the advantage of this one is the market has now printed a first higher low and given you another high high. So you've got two high highs, and price is on its way to create two higher lows, and that's enough. That's where the double confirmation lies in that you see two high highs and two higher lows to confirm that the market structure has changed. All right. So this is also a brilliant way of trading. So obviously, with such a beautiful RR that you can see with the confirmations, one may ask, what would be the disadvantage of going with a confirmation entry? Because it looks like everything is beautiful with a confirmation entry. And the key things to note are, number one, it's not all the time that you're going to get price pulling back into a POI to respect or show us a second low. The reason why this happens is POIs are different. Certain POIs are more liquid than others, and as you'll find, the very liquid POIs are the ones where maybe price gets in, there's a lot of demand or a lot of supply, and price turns very quickly. It doesn't give you an opportunity to enter. It pushes straight up to your TP without even giving you a pullback, at least within the region that you'd like to buy. And then with the double confirmation entry, the problem is also sometimes you won't get that double confirmation. You'll get the first confirmation, you wait for the second confirmation, it doesn't come. Price just keeps pushing higher because the trend has changed and now the market makers are in charge. You get a lot of impulsive candles. Those kind of things happen on the downside, right? It's things that you need to be willing to live with. And then another thing that you need to take note of is this. So I'm just going to redraw this part so you sort of get to see sometimes what happens. So as you'd appreciate, with a higher time frame POI and the risk entry, you only get one entry per POI, and you get to know whether you're wrong or right only once with that POI. But when you have price moving down in this fashion, sometimes price taps into your POI, gives you a change of character, and draws deeper into the POI, right? And then gives you another change of character, comes back and whacks you straight through. Now, what has just happened is you've been presented with two opportunities to take a risk entry. First over there by seeing a change of character, and second over there. So you see this change of character twice, and you take two trades within the same higher time frame POI, but then the market still breezes through and takes you out. So what's just happened is you've lost two trades, and you've got no idea why the market presented you with so-called confirmations and yet it still let you down and breezed through. It's because there's demand that's sitting in here, and the change of character is highly likely to happen. All right. So if you were the guy who was going to wait for a double confirmation, then you wouldn't get it and you'd be safe. All right. But of course, in many ways, whilst this is a method that is uh, to apply sometimes because changes of character present themselves in very, very different ways, um, you'll still find that in many ways this is better than taking a risk entry because you get your confirmations in place. So it does happen sometimes that you see your confirmations and the OB is not respected. What you simply need to do is to make sure that you limit your risk so that you're not risking a very large percentage of your account, because when this eventually does play in the right POI and price moves in your direction, your RR will be so big it will allow you to then recuperate all your losses and come back into a profitable position. But also, this from a psychological standpoint, it does require you um, to be strong psychologically because it's the kind of thing where you can take a string of losses at the same time, and then you have one very nice and beautiful trade sort of cover up and give you more. So if you're not patient within the losses, then you begin to question yourself, and you're the kind of guy who has got a psychology that's not strong enough to trade this kind of strategy. It's perfectly fine. There's nothing wrong with you. You don't need to try to be other people. You don't need to try to be another trader. All you simply need to do is to adapt and look for something that works for you. Okay. So what I would encourage you guys is definitely consider these methods of entry. There is one other method of entry that I've seen people sort of use, and I'm going to illustrate that one for you. So with this one, what you simply see is when price reaches your POI, people wait for price to give them a rejection candle. So right, price reaches your POI, say this is your higher time frame POI, right? And what you simply do is when you get this rejection and you get a momentum candle, as soon as you get the momentum candle within this POI, what do? You whack on a buy stop above the momentum candle, and you put your stop loss here, and you let the trade go wherever it's supposed to go. All right. So that means if the next candle is going to go above this price, you're going to be triggered, and hopefully you go with the momentum long. All right. So this is another method of entry that I've seen people take. It's always up to you which method you then choose. Obviously, you need to go to a lower time frame to sort of see these confirmations and take those buys and go along with the market. All right. So what we're going to do is we're obviously going to discuss these entries from a standpoint of the candlestick chart, and I hope you guys to see these things as they play out, because obviously I know that it doesn't always present itself with the simplicity of a line, so we can't leave these as line charts or line demos as if it's that simple. So let's just go to the market in the next video, and then you get to learn how to apply these things.